And you mentioned you've been talking to some people in the administration, no names, but they're, they're not negative about this type of idea.
Well, the subject lines I'm getting back in emails are love this idea.
Great.
So, but people who have been involved and continue to be involved, and I, whenever I've spoken specifically about this as a potential initiative, I'm just saying that this has historically been an anchor for stable monetary systems, and people such as Alan Greenspan and Paul Volcker, the former Fed chairs, legendary Fed chairs, had great respect for the role of gold in international monetary systems and as a bulwark for individual countries for the monetary integrity of their currency.
Welcome back. I'm Jeremy Szafron. Well, the Federal Reserve paid over $200 billion in interest to banks last year. Billions of that went to foreign institutions. And meanwhile, American households endured the worst erosion of purchasing power since the early 1980s. Now, Judy Shelton calls this structure perverse. And now, under President Trump's second term, Treasury Secretary Scott Bessent is calling for a sweeping review, not just of Fed policy failures or bloated construction budgets, but of whether the central bank is even fulfilling its mandate. Today, we go directly to the source. Judy Shelton, former Trump nominee to the Fed and author of Good as Gold, joins us with a blueprint to re-anchor the dollar, rein in central bank discretion, and restore public trust in American money. Dr. Shelton, welcome back to Kitco. It's great to see you.
I'm delighted to be with you. Thank you.
Appreciate your time. Obviously very topical right now. The Fed is in the headlines. And you just did an interview, and I found it interesting. We'll start with that because most Americans don't realize that the Fed paid over $200 billion in interest last year, 40% to foreign banks. Now, we said that you called this structure perverse. What's actually happening here, Judy, and how is it justified?
Well, what happened, people remember in October of 2008, the great global financial meltdown. And as part of the reaction to that, an emergency package allowed Congress to give the right to the Federal Reserve to pay interest on the cash balances that commercial banks are required to maintain at the Federal Reserve. Normally, they were not getting any interest on that. There were required reserves. But he knew, Ben Bernanke, who was chairman of the Fed, that he was going to initiate, through our central bank, massive purchases of government assets. That means the Fed would be buying Treasury securities, buying Treasury debt to finance deficit spending by the government, trying to keep the economy afloat and trying to drive interest rates down to zero. That was going to be how the Fed responded to the global financial crisis. Normally, that could cause hyperinflation because when the Fed buys securities from banks, you hear people say the Fed can print money. Well, what they do is with a keystroke, the Fed is really saying to the bank who's selling the security, we will now credit your cash balance, your deposit account here at the Fed for $1 million, say, whatever the cost of the Treasury security is. And they just do it. They just click. And now that's another $1 million, which is real money to the bank. And normally, that would mean the bank could lend that money out. There's a multiplier effect. It goes through the economy, making loans and people taking out new bank accounts as part of the loan. And that can unleash hyperinflation. So the idea was if you let the Fed pay interest, as Ben Bernanke said later in a 60 Minutes interview, I can raise interest rates in 15 minutes. Because now, instead of having to go through the messy process the way Paul Volcker did when he was Fed chair of engaging in what we call open market operations, having to buy and sell treasuries directly interacting with the market, instead the Fed could use this kind of diktat approach and just say to the banks, we will pay you this much interest to keep that money sitting in cash and not lend it out. Well, the Fed never anticipated we would. In those days, we were talking about a 1/4 point of interest. And the Fed never anticipated that it would get to the point where not only it was paying, like right now, 4.4% interest and that's on 3.4 trillion in cash that is kept by private commercial banks in their deposit accounts at the Fed, but that all of the money the Fed makes on its own portfolio, because it holds as securities these Treasury debt issuances, all of that money is being transferred to the private commercial banks as interest payment. Yeah. And to keep the money sitting at the Fed instead of going into the economy and maybe generating too much economic activity, which the Fed thinks could threaten inflation. And so it's gotten out of hand, and now foreign banks who get much lower rates at their own home central banks, they're stashing their money at our central bank to get that rate. So I might just close by saying, recently, people might have heard how President Trump was complaining to the Fed, saying, why is our interest rate so high compared to all these other countries? And he gave a list of maybe 30 or 40 other countries, and their interest rate, their policy rate that their own central banks establish were considerably less. Like the European Central Bank, their interest rate is 2%. So the idea is that it doesn't make sense. There's a disconnect. And so now you have a situation where how do you prevent the Fed from using this mechanism? How do you take away that emergency right to pay interest and make them go back to the Paul Volcker way of fighting inflation, which would require the bank to sell some of those, sorry, it's getting complicated, but sell some of those Treasury securities and in that way shrink its balance sheet and become less prominent in financial markets.
Yeah, no, I mean, you didn't lose us there. I mean, it makes sense. It almost feels like it's not, a neutral monetary tool anymore. It almost feels like it's become a quiet subsidy to the financial sector.
Exactly.
Okay. So I guess the question is then, Judy, I mean, should Congress revisit the authorization of interest on reserve balances? Like, who is the Fed accountable to at this point?
Well, I believe Congress should revisit it, and it's precisely because the Constitution gives the power to regulate the money to Congress, Article 1, Section 8. It's in the same sentence where the Constitution gives the right to Congress to establish official weights and measures, because money was always meant to be a measure. And so it really is a matter of congressional oversight, and they haven't really paid attention to the Fed's use of this tool, I think partially because we've been told that central bank independence is so sacrosanct that I think Congress has felt absolved of exercising that kind of regulatory oversight of what the Fed does. And at the same time, it has insulated the Federal Reserve from being criticized. But right. Bernanke himself, the former Fed chair, recognized that they had an appearance problem from the start, that this would be seen as a subsidy to private commercial banks. But at the time, he said, don't worry, because it's only 25 basis points, such a small amount of interest we can't get too excited about. Don't worry, because the Fed generates so much money on its own portfolio, it easily can cover the expense of paying interest to commercial banks. And finally, he said, don't worry, because this is temporary. We're going to normalize our balance sheet and the way we operate. And we will be selling back all of these government securities we purchased in the emergency. Unfortunately, none of those things happened. Yeah. And now interest rates have gone up multiple times higher than that. The Fed does not cover its own expenses. It's using up all the returns on its portfolio and paying it out to banks and requiring more money beyond that. So it's going into debt. And it's really the Fed is going into debt to the Treasury because normally the remittances, that is the earnings that the Fed makes on its own portfolio, are required by law to be remitted, given back to the Treasury, where they become revenues to the federal budget. So what had been formerly a big source of revenues to the federal budget is not only gone, and has been given to the private commercial banks. But in addition, the Fed has paid them another $200 billion beyond the amount it was making off its portfolio. So it'll be years before it can even catch up and start once again contributing revenues to the federal budget. And the fact that over 40% of that is going to the foreign banks, I think would irk most Americans if they understood how that mechanism operates.
Yeah, good point. And you've long argued that the Fed lacks democratic accountability. And obviously, there's lots to unpack on the headlines today, Judy. I mean, we got Mohamed El-Arian. He says that Powell should resign to preserve the legitimacy. And I mean, just this morning, Senators Rick Scott and Rand Paul are now pushing legislation to audit the Fed's books. But Bessent just came out, and I think it was his story today, and said that he shouldn't resign, but that he must lead a full internal review. Where do you fall?
Well, I think we're talking about a fundamental review, but not just of the non-monetary policy aspects. I did notice that the Treasury Secretary this morning still referred to monetary policy as a jewel box, meaning we don't want to compromise the independence of the Fed. But I think I differ in that I see it as a lockbox. I don't think the Fed, if a reporter were to ask the Fed chairman, say next week, there's always a press conference after the latest Federal Open Market Committee decision regarding interest rates. If they were to say, is it true that over $630 billion has been paid out in interest payments just since September of 2022 when the Fed started running at an operating loss? Is it true, Chair Powell, that over 40% has gone and is continuing to go to foreign banks? I wonder if he would answer that question. You can find it in the data, but it's really buried in the data provided by the Federal Reserve. If you were to ask him how many tens of billions have gone to individual banks, the largest banks in the U.S., say J.P. Morgan or Bank of America or Wells Fargo, how much have the largest banks in the United States received in interest payments just for keeping money sitting in cash and not using it to either buy Treasury securities, which would help bring down those rates, the rates that really matter to people. Say the 10-year Treasury rate used to be the benchmark. So if banks weren't getting 4.4% from the Fed for keeping money and cash sitting there, would they then invest it in treasuries? And would that increase demand, bring down interest rates? And I think the answer is yes, it would. Or they could actually lend it. They could make it available, access the capital for small and medium-sized businesses. All of those things would be much better than, I think, simply paying banks not to make loans.
Yeah, you mentioned it. I wish I could ask Jerome Powell that question, but I can ask you, a little bit more on this, Bessie, because he did say, he made an interesting kind of comparison. He said that if the FAA made this many mistakes, it would trigger a full investigation. But when the Fed oversteers or drains household wealth, of course, there's no inquiry. Has the Fed's independence, become kind of a shield against oversight here?
Shield is the right word. I definitely think so. The members of the Federal Reserve like to have total discretion. They do not want to have any kind of rule governing their decisions. I thought that former Fed chair and former Treasury Secretary Janet Yellen this morning was really showing that this is going to be a battle. As a central banker, she was saying that you cannot violate the central bank independence. And I think that has become a shield. And as much as Federal Reserve officials talk about transparency and accountability, I really think they need to explain how is it that you now have an operating model that is spending more to pay interest to commercial banks that it generates on its own portfolio and is there becoming, we used to count these remittances as revenues to the budget. Right. But now we don't count it as an outlay. The fact that they're generating this loss, which is accumulating and is coming out of Treasury revenues, I think that's something that the Fed needs to explain. And the Fed's own portfolio has over $900 billion in unrealized capital losses. So there are issues of mismanagement that need to be explained and addressed. I think the Fed's mechanisms are proving to be a problem. I think its models are also a problem. So when Secretary Bessent talks about fundamental reform, or one candidate, Kevin Warsh, who could possibly be a future Fed chair, talks about the need for regime change, I'm in agreement with that. In fact, I wrote an article. It was the lead op-ed for the Wall Street Journal in April of 2019 called The Case for Monetary Regime Change. Because I believe, and I was talking then about the Fed's practice of paying interest on reserves would end up causing big problems. So that was well in advance of when this would turn into officially an operating loss. But those are the kind of things, the models, the constructs, and the mechanisms of the Fed that need to be examined. And so it's not just whether they lower 25 basis points in July versus September, and it's not even the overspending on the building, although I think that becomes the thread that is being pulled to unravel a lot of the misdirected decisions being made at the Federal Reserve.
Yeah, I wanted to talk about that new monetary reset. Before we do, because you were talking about 2019 when you wrote that op-ed, I mean, you were blocked from joining the Fed in 2020 over your mainstream views. Now those views on inflation, gold, and of course the structural reform we're talking about, I mean, they're being championed and obviously widely echoed in the Trump administration. What's changed?
Well, I guess since you mentioned gold, I will say a couple of things. We find central banks buying gold. We find people going to Costco and buying gold. In the last 2 months, Florida and Texas have signed legislation to allow people to pay for everyday transactions using electronic payment platforms, debit cards, mobile applications, to use gold as the medium of exchange. And those states are counting that as legal tender. And I find that fascinating, this movement in favor of sound money, constitutionally defined money, quite indicative of this hunger for sound money. And I think it's much more in keeping with what the founders had in mind when they made gold and silver the only kind of money that would be acceptable. Because think of American history. We had colonies. Those colonies also did the old trick of forcing people to accept government IOUs as legal tender. And it really leads to financial breakdown and chaos. So they decided they wouldn't do that anymore. And so now you're having the fiat monetary system managed by the Federal Reserve competing somewhat with this new form of money. When Governor Ron DeSantis announced that he was signing this 2 months ago, he said, we want to restore economic and financial freedom to our citizens. Governor Abbott posted, as he signed it on June 29, not very long ago, that we want to have money consistent with Article 1, Section 8 of the Constitution. So they're taking these things quite seriously. I don't think you can any longer say this is a cringe right-wing radical approach. These are governors of major states, and I'm sure they're responding to demand among their own citizens. And I hope this is going to be a warning to the Fed, but I see central bank officials kind of doubling down and protecting this central bank independence approach. And I don't want them to turn Chair Powell into a martyr who refuses to be fired, whether by the president, by Congress, or by anyone.
Yeah, well said. I mean, does this come back to the gold-backed Treasury idea? I mean, obviously, we had you on this show about 8 months ago, and we chatted about your book, In Good as Gold, and you proposed that long-dated U.S. Treasuries redeemable in gold, and you mentioned that July 4th, 2026, America's 250th birthday, as a possible launch date. Judy, where does this initiative stand now, and who needs to get on board?
Well, I think it's a fairly modest proposal. I've received some comments and enthusiasm from people who are involved in the administration. I won't say more than that, but it would be a very appropriate lodestar to establish as we move into this new golden age for America, which is emphasizing the real economy and small and medium-sized business, and saying it's time to have the monetary system and the entire economy work for Main Street as well as it seems to work for Wall Street. And I think that's very important. There's so much speculative activity in currencies and derivative markets and these very sophisticated financial hedges. And maybe that's fine for Wall Street people or people involved in financial markets who can watch the cable channels all day and figure out the latest public utterance by a Federal Reserve official. But for people who just need access to capital, to expand plant and equipment, to hire more workers, to create more output, that to me is the way that you prevent inflation. It's not by trying to kill demand, which is what the Fed does with high interest rates. It's about increasing supply. When the Fed pays high interest rates, the government's going to go ahead and pay it. They may be complaining, as the president is complaining now. But the point is, when the government sells debt, Treasury debt is sold by auction. So whatever the interest rate is, that's what government pays, and they just tack it on to future expenditures in the budget going forward. But in the real economy, high interest rates are a genuine obstacle. So I think that when the Fed acts as it's being a great disciplinarian and resisting pressure, what they're really saying is our stance will empower government because fiscally you're overspending, running a deficit, hugely stimulatory approach. And so the Fed then takes this opposite approach of constraining. You hear them talk about restrictive rates. They admit the current rate is restrictive on purpose. But who is that hurting? Yeah. Only the people who have to pay that excessively high rate to get access to capital. And just one more point, that's why we've seen an explosion in private credit. And I think what the Fed is missing is that banks are willing to play the game with the Fed and let the cash sit there and collect the interest. But meantime, they are making loans to private credit, non-bank financial institutions, and over 50% of the money being provided through financial intermediation to small and medium-sized businesses is not coming from banks anymore. But that was the whole rationale for having a Federal Reserve and for making all banks be Fed members. And I just think that you're seeing a kind of regulatory arbitrage where these non-bank financial entities are providing that cash, those loans, and they're not subject to Fed examinations. And so I think we're looking at a potential real disconnect because if those loans were to go bad, now who is responsible for them, and what can the Fed do about that?
Well, not much, right? I guess that gets you back to that, the gold-backed. I got to ask you, because Nixon ended convertibility in 1971 because foreign governments, especially France, were draining U.S. gold reserves. I mean, now we're seeing even some offshoring and central banks obviously bringing a lot of gold. How would your proposal avoid a repeat of that scenario, especially with countries like China diversifying away from the dollar?
Well, first, what I'm suggesting is that this be a very long-term bond. Yeah. It's possible you could have interim, shorter duration subsets of a gold-backed Treasury offering. But it's really to function as the beachhead, to say we are committed not just to sound finances, which to me is when the president talks about wanting to balance the budget, that's sound finances, but sound money. And those two have to go hand in hand. So if you had a 50-year bond, and I say that because some countries already do, France does, a number of countries have had 50-year bonds, and it was considered in the first Trump administration. Right now we only go out 30 years. But if there were investor demand, think if on July 4, 2026, which is going to be the 250th anniversary of our nation's founding, Treasury offered for the first time since 1971, when President Nixon closed the gold window and ended any kind of gold convertibility for the dollar, you would be establishing a link between the US dollar and gold. And what it would do is entitle the bondholder. It's just like making a long-term loan to the government. It's like buying a 30-year treasury, only it would be 50. But it has this convertibility aspect to it, meaning at maturity, you would have already pre-established that the bondholder could exercise the right to either be paid in the face value of the bond, which would be denominated in dollars, or at a pre-specified weight of gold. Now, in a way, it's like a novelty. We do have the world's largest official gold holdings, 261 million ounces. It's worth somewhat less than $1 trillion. We're carrying that on our books as being worth only $11 billion. So I think the U.S. government could already find a way to capture the windfall profit. But they would have to literally warehouse the gold to say, this is the collateral. It's the family jewels, but this is a family emergency. We're going to warehouse that collateral because we are committed to the United States remaining a major force, a major leader in the world at the time of our 300th anniversary. So we're saying that in 2076, the United States is going to be standing tall. And between now and that date, we're working our way towards sound finances and sound money by effectively establishing a Treasury security that provides a return in dollars that are as good as gold.
And it would bring back or restore that, market discipline to the monetary system, that, Judy?
I think it would, at the very least, be a sort of a price rule for Federal Reserve officials. Right now, they look at TIPS bonds, which are Treasury inflation-protected securities. And what that means is if you buy a TIPS bond, you're saying, yes, I'll make a loan to the government. I'll invest in a government bond, but I'm afraid of inflation getting out of hand. So I want to guarantee that I will be compensated for inflation. And so a TIPS bond gives you not just the return that you're expected to get, but also you get paid in accordance with what the consumer price index showed. So if the CPI went up a certain percent, you also get reimbursed for that. Because it's for bondholders who don't want to lose purchasing power. And it would be very similar with this type of a gold-backed instrument. It's just that you don't want to lose purchasing power, but you don't define it in terms of the CPI or a market basket of goods. You're saying, I see gold as a surrogate for purchasing power, kind of a surrogate for commodities and the real economy. And so I want to have that guarantee. I'm paying extra to get that. And all of this means that I think the U.S. government could borrow at a considerably lower rate of interest because people would pay a premium for that kind of protection of their purchasing power defined in terms of gold.
And you mentioned you've been talking to some people in the administration, no names, but they're, they're not negative about this type of idea.
Well, the subject lines I'm getting back in emails are, love this idea.
Great.
So, but people who have been involved and continue to be involved, and I, whenever I've spoken specifically about this as a potential initiative, it's just an overwhelmingly positive response because I think so many Americans do think that gold, they either have it as part of their portfolio or they buy gold bars. I'm not saying what people should do. I'm not speaking in investment terms. I'm just saying that this has historically been an anchor for stable monetary systems, and people such as Alan Greenspan and Paul Volcker, the former Fed chairs, legendary Fed chairs, had great respect for the role of gold in international monetary systems and as a bulwark for individual countries for the monetary integrity of their currency.
Yeah, well said. Not to mention the 5,000 years of history. And I should say gold's above 3,400 today, so it's not going anywhere. I made some notes here, Judy, when we were just talking, and you were talking a little bit about the Fed's balance sheet and those hidden losses. I just want to go back there because You mentioned that it holds almost $1 trillion in unrealized losses, mainly from those long-term bonds bought at, near zero rates. Meanwhile, it's that operating loss have forced the Treasury to suspend these remittances. I just want to ask you, we hear about this Reno, even though that's a different story. If the Fed were a private bank carrying this much leverage and unrealized loss, wouldn't regulators shut it down?
Immediately. Absolutely. The Fed does not abide by GAAP. Those are the generally agreed accounting practices that normal businesses are required to work in accordance with. The Fed has its own set of accounting rules. There's the SOMA approach. That's a system open market accounting approach. And that causes another complication for the Fed. If the Fed were to eliminate paying interest on reserves, then the natural thing would be, as that rate went to zero effectively, if it were phased out, that they would do the Paul Volcker method of trying to push interest rates up to whatever level they thought were appropriate. I even have qualms about why a central bank should be fixing the cost of capital in a free market economy. But given that we allow our central bank to influence, you might even say manipulate the rate of interest, then their next logical way to do that would be by selling their holdings of treasuries. They have about 6.7 trillion on their balance sheet. So they could be selling those securities. But when you have $1 trillion, close to $1 trillion loss in your portfolio, then even if you quit paying the interest out to the banks and the interest you were making on your own portfolio is now available to remit to the Treasury to help fund the federal budget, the Fed they don't have to take the loss until they sell. They don't have to mark to market. They only take the loss when they sell the security. That's why you see the Fed instead saying, we'll just allow them to run off. We'll allow the runoff. Because if you allow the securities to mature, then there is no loss. They don't recognize a loss. But if they sell them, they have to recognize the loss. And the losses are so high, it could wipe out that potential income and not be able to remit it to the Treasury. So there are quite a few things. Let's just say if you had a portfolio manager for your company or personally, and they engaged in that type of behavior, you would have lost a fortune.
Yeah. And they'd likely be behind bars, too. You've written that the Fed now exercises powers far beyond that, what the Constitution kind of envisioned here. We were talking a little bit about that. Should Congress take some of that back?
I think that Audit the Fed is important, that whole movement, but not just the accounting. The Fed is audited by an accounting firm, and so the numbers are out there. But what you need is the explanatory part of it, which is what I'm trying to really bring transparency to, so that people understand this mechanism that has become the primary tool that the Fed uses to influence the interest rate. I think that Congress has not exercised regulatory oversight of the Fed, and these things have developed in a vacuum of sorts because they are kept within the Federal Reserve. I think the Fed feels vulnerable that these practices could be exposed, and that's why you're kind of seeing this insistence that don't you dare violate central bank independence by questioning how we conduct monetary policy. But I really think it's vital to expose the models and the constructs and these mechanisms, as I'm saying. So Congress may have to rethink the powers. It effectively farmed out its responsibility to regulate the money to a federal agency. But we need to examine why the Fed claims independence. For one, if you look at the Federal Reserve website, they give 3 reasons why they are, quote, independent within government. That's how they word it. And one reason is because they say we don't have to go to Congress for appropriations. And they say that kind of smugly because we fund ourselves. Well, that was true for over 100 years. But since September 2022, it's no longer true. They do not cover their own expenses. So there goes one justification for being independent out the window. Another one is they have 14-year staggered terms for members of the Federal Reserve Board of Governors. But almost no one stays for that length of time. Mm-hmm. And now I see that very idea even being weaponized somewhat, because there's sort of this inherent possibility that even if Chair Powell, after he steps down, when his 4-year term as chairman of the Fed ends, he really has another 20 months until January of 2028 to stay on, because that's the length of the former 14-year term when he became a member of the Federal Reserve Board that would still be available to him. So now you really would have two potential chairmen, because the committee that makes the interest rate decisions, they elect their own chairman. And even though it's always been the person appointed to be chairman of the Fed, it doesn't have to be. You could potentially have a chairman appointed by President Trump, and yet the policy-making committee could elect a different chairman, and it could be Powell, who would still be a member of the board. And finally, the third reason the Fed says it's independent is because members of the administration or elected officials are not allowed to serve at the Federal Reserve. But we see, and it was interesting, Janet Yellen was questioned specifically on this morning. But how do you explain then how you go from being a Federal Reserve chair to being Treasury Secretary, as she did? Or the vice chair of the Federal Reserve, Lael Brainerd, became the director of the National Economic Council. That is a completely partisan organization housed in the White House complex that gives direct political advice to the president regarding the president's economic growth agenda. So it is a revolving door, and I think for these reasons, the Fed's own justification for being independent, it has been more than eroded.
Yeah, no, it's a heck of a thesis. I mean, it makes sense. And Dr. Shelton, our time always goes too fast, but I guess we'll close with, would you accept a nomination to succeed Jerome Powell as Fed chair in 2026?
Well, it would be an honor to even be asked to consider that. But really, that's a question I would only answer with regard to my husband, the president, and myself. That would be a conversation among us.
Yeah. You mentioned Kirsch. I mean, some interesting talk about some leaders here that could kind of step into the place.
Yeah, there's a number of people who are being proposed, and I hesitate to comment on those people. I think it's going to be difficult for almost anyone, because it is now being set up that if they agree with President Trump that rates should be lower, they will be accused of being a lackey. Yeah. And so that undermines, again, their potential effectiveness, because we've been perpetuating this myth that the people at the Fed are nonpartisan, that they're apolitical. But I don't believe that you walk out of the Fed and go to work for an administration, and that somehow when you change hats, you've gone from having a certain political philosophy to now a partisan one. What I mean is, if you really believe that you should have an independent Federal Reserve, you should be more inclined toward having a rule-bound approach to monetary policy and not make it dependent on the wholly discretionary judgment of a dozen people who vote 8 times a year to fix the price of loanable capital. Those people are human, and they vote, and they're appointed by presidents who are Republican or Democrat, and their whole passage through Senate approval depends on how politically palatable they are. So I think we have to move toward, you might say, more a rule of law, not a rule of men or women, and have money governed in a way that I think honors the moral imperative of that Americans in particular deserve to have sound money because it has to serve as an honest measure. So you can plan your life in accordance with founding principles of economic freedom. It has to be a reliable unit of account. It has to convey meaningful price signals. And I think especially it has to be a dependable store of value. Mm-hmm. So that's the appropriate mindset for anyone who would aspire to be Fed chairman. And I hope that will turn out to be the case.
I appreciate it. Always clearly said. Dr. Judy Shelton, Senior Fellow at the Independent Institute, former Trump Fed nominee and author of Good as Gold. Dr. Shelton, thank you for your time, your insight. Always a pleasure to have you.
My pleasure. Thank you for inviting me. Enjoyed it.
Thank you. Have a great summer. All right, if you found this conversation valuable, make sure you're subscribed to Kitco News right here on YouTube. We bring you direct, unfiltered interviews with the market movers, monetary thinkers, and of course, policymakers shaping the global economy. Tap the bell to stay ahead. I'm Jeremy Szafron. Thanks for watching.